On paper, the US economy looks fantastic right now. You see employment steady on the aggregate jobs data. The ISM services has remained solid and afloat. You see the stock market at or testing all-time highs on the backs of a few popular AI stocks. And you see inflation remaining afloat, but not uncomfortably high. So the question is, if the economy is doing so great, why do people feel like they're in so much financial pain right now? Why is the savings rate at record lows in this country? And why is it that you see more people falling behind or lacking emergency savings, which just is the sense of impending doom or gloom? Welcome to Analyzing Finance with Nick. And in this video, I'm going to be talking about running the treadmill, which is the idea that a lot of the supposed economic growth may not actually be growth. So what am I talking about when I mean running the treadmill? Say you are a professional who makes $100,000 a year. Let's say after tax, you're taking in about $6,000 a month. And let's say your living expenses at the start before the great inflation were all in about $4,500 a month, with $2,000 for rent, $500 for your car, $500 for your food, and $1,500 for everything else. And so therefore now you have $1,500 left over for savings every month. And let's just see you had a wave of inflation with, say, housing bill going from $2,000 to $3,000, the car staying the same, and your food going from $500 to $750, and your other costs going from $1,500 to $1,750. So all in, let's just say your costs are now up from $4,000 now to $6,000. And so therefore, you could still afford everything, but you have nothing left over. So now your total expenses gone from $4,000 to $6,000, with the bulk of that being in housing and food in this example. Your income is still the same at $6,000. And let's just say the official CPI numbers, which are often distorted because a lot of the stuff that is nice to have, but you can live without, is going down in price. Say, for example, buying a TV or airline tickets to fly on vacation. But since now you're not saving anything, you can't afford to go on vacation. So your basket is not really affected by the stuff in the CPI that is going down, but it's affected by the stuff that is going up faster than CPI, such as housing, which is the example in the real world, or in this example, food. And so as a result, the official inflation number may have only had, say, 10% cumulative inflation over this period, but your expenses are up 50% over this same time period. So that gap between your expenses going up and the overall CPI going up is contributing to real GDP growth, because real GDP growth is nominal GDP discounted by a GDP deflator, which is official inflation. So the extra amount you're spending above whatever the official inflation rate is counted as real GDP growth, even though there really isn't any growth or living standard improvement happening. You're spending more money for the same amount of stuff, but just because your basket, and I think this is done to apply to this example, I think it's more common than what the CPI basket would indicate. So your basket is going up way more than the official CPI basket, your extra spending counts towards growing the economy. And this is so common for a lot of people, particularly those, say, under 45 years old, that they're like, hey, wait, my living standards are falling or staying the same, and I can't save any more money. And so my financial situation is worse. Fortunately, in this example, he's break even, but many others, they now have to delve into credit cards to cover the shortfall, just to cover the same amount of living costs, but everything is priced higher. And so this is what it's called. I call it running the treadmill, because you're having to spend more money and move faster on the treadmill. But like a treadmill, you're not going anywhere. You just have to put more energy and more effort for the same or less results. And eventually you get tired. If you're running at a treadmill at 10 miles an hour and you maybe have the energy to do that for say 10 or 15 minutes, but eventually even the most in shape runners are going to run out of energy. If you don't get off the treadmill, you're going to fall off the treadmill. And that inevitable fall off the treadmill is the biggest risk to the economy and the market right now. I mentioned this in my persistent inflation video earlier, but that's what I think is going on here. We just have a collective, at least in the US economy, and I'm sure it applies to other developed nations, a collective running of the treadmill going on. And it could last as long as savings continue to get depleted or incomes can catch up to cover part of the blow. The other side, though, that I could be wrong on this, is you have a lot of baby boomers retiring. And their retirement, as you see with 401k balances starting to, for older people, mellow out or draw down, their savings for retirement they can use to go on vacation and travel and do other things. And this counts as a declining savings rate because these people aren't working anymore. They're drawing out of their savings or their compounded investments for retirement. So that might just explain it, is that maybe things are going well, but the savings rate looks weak and consumption is going up at a pace than spending than real incomes for the last year or so, not because people are inherently getting poorer, but just that older people are retiring and now they're having a chance to enjoy their golden years before they're too old to get on an airplane or too old to participate in their hobbies that they have time now to pursue. So that's the counter argument. But either way, this economy is driven on people spending more than they're making. And it makes me question the sustainability of a lot what's going on. If you had to disagree with me, let me know what you think. And if you like these more current event, like macroeconomic type analysis, feel free to like, subscribe, and share. Thank you for watching.